Hey everyone, welcome back to Corporate Decoder. In this video, we will be dissecting Kestra Medical Technology's latest financial report, the 10Q. It seems like they've had a really interesting quarter with some big steps forward and a few bumps along the way. So buckle up because we are about to decode it all. Let's dive into what Kestra Medical Technologies has been up to in the most recent quarter ending July 31, 2025. This report gives us a closer look at Kestra Medical Technologies, a company focused on wearable medical devices for heart patients. Remember, they got their big FDA approval in 2021 and have been working hard to get their Assure WCD system out there. Looking at the financials first, revenue really jumped up. For the 3 months ending July 31, 2025, revenue hit over $19 million. That's a solid 52% increase from the same period last year when they brought in around $12.7 million. This growth seems to be driven by getting more patients using their device and a better collection of payments from insurance companies. Now let's talk about gross profit, which is what's left after you pay for the cost directly related to making and delivering your product. Kestra saw a fantastic increase here with their gross profit more than doubling. It went from about $4.2 million in the prior year's quarter to nearly $8.9 million this quarter. That's an impressive 11% jump, a huge sign that they are getting better at managing their costs as they sell more devices. However, not all the news is sunshine and roses. Selling general and administrative expenses, which cover things like marketing, salaries for non-product staff, and administrative overhead, also shot up. They spent almost $33.7 million on these costs this quarter, compared to just about $19 million last year. That's a massive 75% increase. The company explains this is due to more staff in sales and marketing, higher costs for legal and accounting as a public company, and increased travel. All these increased costs, especially in sales and marketing, led to a bigger operating loss. The loss from operations widened significantly from about $18.4 million in the prior year's quarter to almost $28.9 million this quarter. It's a 57% jump in the loss. This shows that while sales are growing, the company is still investing heavily to expand its reach. On a brighter note, the company is earning more from the cash they have on hand. Interest income went from a tiny amount last year to over $2.1 million this quarter. This is likely because they raised a lot of money in their IPO earlier this year, and they now have a much larger cash balance that's earning interest. Despite the revenue growth and higher interest income, the overall net loss for the company also increased. For the 3 months ended July 31, 2025, the net loss was about $25.8 million in the same period last year. Let's look at the balance sheet and how much cash they have. As of July 31, 2025, the company had over $2,000 million in cash and cash equivalents. This is down from about $237 million at the end of April. This decrease makes sense given the operating losses and the investments they're making. Now, something a bit more technical but very important: warrants liabilities. Essentially, these are financial instruments that give someone the right to buy the company's stock at a certain price in the future. The value of these liabilities changed quite a bit. They dropped from over $8 million at the end of April to about $5.2 million by July. This change in value, a decrease of almost $2.9 million by July. This change in value, a decrease of almost $2.9 million by July. This change in value, a decrease of almost $2.9 million actually helped reduce the company's overall expenses for the quarter. The number of common shares outstanding stayed the same, around 51.3 million. This is important because it helps us understand earnings per share. The company also granted some restricted stock units and options to their employees and advisors. This is common practice to attract and keep talent. They've granted over 1.2 million restricted stock units and over $4.5 million for the quarter, mostly going into selling general and administrative expenses. Given all this, the net loss per share also went up. It was about 50 cents per share this quarter, compared to 1.20 per share in the same period last year. While the per share loss is better than last year, it's important to remember that this is because they now have many more shares outstanding due to their IPO. The actual dollar amount of the loss increased. Now let's touch on something that caught my eye. The company admitted to several material weaknesses in their internal controls over financial reporting. This basically means there are significant gaps in how they track and report their finances. They mentioned issues with having enough people in accounting and finance not having strong enough checks for complex transactions, and problems with IT controls like managing changes, user access, and data backups. These kinds of weaknesses can lead to errors in financial reporting that could be missed. They are working to fix these, but it's definitely something to keep an eye on. The massive increase in selling, general and administrative expenses is a big story here. It's up 75%. While growth is good, the sheer amount spent here, more than $33 million in just 3 months, shows how aggressively they are pushing for market share. Their revenue is growing, but their expenses are growing even faster in this area. Let's circle back to the revenue. That 52% increase is really the star of the show for Kestra Medical Technologies this quarter. It signals that their core product, the Ashar WCD, is gaining traction. The fact that they've improved collections by growing their revenue cycle management team also suggests a more systematic approach to getting paid, which is crucial for a company in the healthcare space. The impressive 111% jump in gross profit is another major win. It means they are getting more efficient at producing and delivering their devices. Lower disposable costs and better use of their equipment pool are good signs of operational improvement. When we look at their cash situation, they have a healthy amount of cash, over $2,001 million. They believe this is enough to cover their needs for at least the next 12 months. However, they also acknowledge that if things don't go as planned with revenue, or if expenses are higher, they might need more money, possibly through future stock or debt offerings. So my take on Kestra Medical Technologies is that they are in a crucial growth phase. The revenue and gross profit numbers are very encouraging, showing market acceptance and growing efficiency. However, their operating expenses, especially in sales and marketing, are ballooning, leading to larger operating losses. The material weaknesses in their internal controls are also a concern that investors should watch closely, as they need to strengthen these as they scale. It's a classic high growth, high spend scenario. They are betting big on capturing a significant share of the market for their cardiac recovery system. The key will be managing those expenses effectively while continuing to grow revenue and, importantly, solidifying their financial reporting processes. Alright, that's our breakdown of Kestra Medical Technologies' latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.